Welcome to another edition of Inside the Economy. I'm Brian Geeman. Thank you for joining me and happy holidays. Today's topics will include stock market performance and the AI trade, weakness of the US dollar, as well as GDP figures, and lastly, we'll discuss inflation, wages, and the US jobs market. As we dive into the economic report, first and foremost, it's great to have updated data. We did have a delay in major economic data as a result of the government shutdown. Earlier this week, we received unemployment figures showing a 4.6% rate as of today. That is a 4-year high, and a bit more commentary on that later in today's video. We are waiting the delayed CPI and PCE inflation data later this week, so please stay tuned to our next video for an update on those figures. Of particular interest on the bottom half, we have crude oil down in the mid-50s per barrel. Stark difference compared to where crude was trading at closer to $70 a barrel this time last year. The Federal Reserve has cut interest rates 3 times in 2025. We are seeing that show up in the 3-month Treasury bills as well as the 2-year bonds, notably lower than last December. On the other side of the coin, longer dated bonds, the 10-year as well as the 30-year remain relatively unchanged, or even in the case of the 30-year bond, slightly higher from an interest perspective than where we were a year ago. So we're seeing a divergence in different parts of the bond world with that backdrop of the Fed cutting interest rates. Last but not least, the mortgage market just cannot crack that psychological 6% number when it comes to the 30-year mortgage. So we'll see if that eventually moves substantially in 2026. Jumping into the markets and the major indices that we track, first and foremost, just great to see a lot of resiliency in the stock market throughout the course of 2025. It's been a pretty bumpy path. Also, really encouraging to see the markets bounce back after that pre-Thanksgiving hiccup that we saw. Ultimately, will we continue to see more upward movements, perhaps that December and Santa Claus rally in 2025? Well, stay tuned. More to chat about in today's episode later. What's powering the stock market? Magnificent Seven, the key tech players that we've all heard so much about, have powered most of the market in 23 and 24, but that is not the case in 2025. Now, there is one asterisk associated with this chart. Since the data was gathered on December the 8th, Tesla has had a pretty nice run. It's now slightly above the S&P 500. But despite that fact, 4 out of these 7 companies are still underperforming the broad markets. So it really shows a story of the market broadening out and participation by not only the other 493 companies within the S&P 500, but smaller and mid-size companies are also performing. So a broadening and more depth within the market is certainly what we would characterize 2025 as. Hard to ignore how well Google has done this year. That is also a continued AI story and one where they've performed, I think, well above expectations. So sticking to the AI theme, Oracle has made headlines in the last handful of months with really large expectations for AI changing their business over the next couple of years. When you look, however, at the backlog compared to the revenue that they're bringing in today, they're really a flip-flop of Amazon and Alphabet at the bottom of the chart. So fascinating to see Oracle, 5 decades of selling high-quality software, amassing a really large consumer base, but really never before has the company's fate been tied to one company, OpenAI and ChatGPT as their lead product. Switching gears, let's talk about the weakness in the dollar throughout 2025. So the greenback has steadied a bit after its steepest first half drop since the early 1970s, triggered as a result of tariffs and Liberation Day, as we've seen. Will that weakness continue if the Fed continues to cut interest rates into 2026? Or will we see a continued kind of firmness if central banks around the world hold interest rates steady or even tighten policy and increase rates? Of particular note here, right in the middle, the euro is up about a 12% or so versus the US dollar in 2025. So large numbers, ones we haven't seen in quite some time. Switching gears, let's talk a little bit about the $30 trillion pie that is the U.S. economy and the GDP figures that we parse through. No big surprise here, but California, Texas, Florida, and New York represent the really key states that drive the majority of the growth in the country. So key players there. Colorado, up about the 2% level or so. So huge growth that we've experienced in the state, and we can see that they continue to show really strong numbers when it comes to our particular state's GDP figures. Switching gears, let's talk about inflation. This chart's going to represent inflation over decades. So going back to the 1950s, the long-term run rate of inflation through this chart is right around 3.5%. So we are a tick above that in the 2020s at 4%, and certainly a substantial move in inflation versus the 2010s at sub 2%. Will we continue to see kind of a 1970s and 1980s theme play out for the 2020s and the 2030s when everything's said and done? That remains unknown, but we have continued to see big ebb and flow in terms of inflationary forces going back over about 70 years worth of data here. Sticking with the inflationary theme and the consumer price index, or the CPI figures, hovering right around that 3% mark as of the most recent release. It is notably higher than the sub 2% mark that we have on the far left side of this chart back to 2014. However, over a longer time period, you can kind of see that we've been really moving in between this 2 to 4% range for some time now, especially the post-2023 timeline on the right side of the page. So fascinating to see us kind of hovering right around the 3% mark, and we'll see how that plays out in 2026. The good news, even despite elevated inflation levels, we continue to see both disposable income as well as consumption growth staying elevated and above general inflation rates. Now, this chart is using PCE inflation in the yellow color, so it's a different gauge versus the CPI figures we just looked at. But the theme is true nonetheless. Over a 3, 6, and 12-month time period, the broader disposable income as well as the compensation growth has been growing markedly above the inflationary levels. So this is a key driver for why we continue to see really robust consumer spending, a fantastic holiday shopping season, crowded planes and hotels across the country as well. So really the consumer continues to be in really good shape, and that's a good thing for the GDP figures and overall health of the economy. Sticking with the job market for just a moment here, we'll chat about the most recent update from this last week and showing the 4.6% unemployment rate. Now, again, this is about a 4-year high when it comes to the unemployment figures. However, when we take a zoom out and look at the 2000 through today chart, we're still at pretty historic low figures when it comes to overall unemployment figures. So are we starting to see some cracks forming or some weakness within the labor market? I think that certainly is the case. However, really important to take, a broader lens and see kind of where we are over the last 25 years or so. Switching gears to something a bit different than the broader economic data, just a fascinating chart showing recovery rates for various parts of the economy going back to 2019 and pre-COVID. And as we can see kind of right in the middle of this chart, the Broadway attendance and above, all back to essentially 100%, or in some cases, well above that mark when it comes to restaurants and hotels. On the bottom half of the chart is where we see some tougher parts of various industries across the United States. I think of particular interest here is the film industry in the red coloring, and the fight for Warner Brothers between Netflix and Paramount that's been playing out. So be interesting to see if there's a large sea change for the film industry in Hollywood in the coming months. Last but not least, the Santa Claus rally. Will it materialize in 2025? History going back to the 1950s would say that it would occur, but it's a second half of December story. On average, from the middle of the month through the end, we see about a 1.4% increase within the S&P 500. So just fascinating to see the beloved Santa Claus rally and what data really supports some of those figures. Overall, we've seen a really strong and resilient stock market in 2025, powered by a lot of companies, not just in the Magnificent Seven group. The dollar had its largest first half drop for the year since the early 1970s. We may continue to see some weakness into 2026. Inflation has steadied right around the 3% mark, yet wages and disposable income are really outpacing inflationary figures, and that continues to spur strong consumer spending. And last but not least, the most recent unemployment figures show a 4-year high. Perhaps again, we're seeing some cracks appearing in the labor market. However, we're still hovering near historically low unemployment figures, which is very encouraging. As always, please send any questions to info@shjwealthadvisors.com. Thank you for joining me, and we will see you next time.
From all of us at SHJ Wealth Advisors, we wish you happy holidays, good health, and prosperity for the new year.